Good afternoon, everyone. Rich Swerbinsky with the Mortgage Collaborative here once again with the last week in mortgage today, our weekly whirlwind through all the latest and greatest in the residential lending industry. Each week I am joined by one of our lender members as my co-host. And this week I am very pleased to once again be joined by SVP Operations for Capital Bank out of the DC, Maryland area, Lisa Lang. Lisa, thanks for joining me.
Hi, Rich. Thanks for having me again.
Excellent. And let's go ahead and get right into it. And as always, welcome your feedback, participation in the show. Any questions, comments, thoughts, funny anecdotes, feel free to drop them in the chat of the Q&A and we will incorporate them into the show. Lisa, as always, a lot going on in the mortgage industry as we kind of have this change in administrations going on, change from the Trump administration and, really a stance on kind of getting Fannie and Freddie out from underneath the government thumb to an administration that's really banging the drum hard, affordable lending initiatives. Obviously, they have new key leaders in place at HUD and all the other key housing-related institutions on the government side. But want to start this week to just get your reaction to a couple of reports that actually broke this morning. One was the result of a survey by CoreLogic. Amongst of renters, 48% of the renters surveyed were worried that they won't be able to buy a home. The biggest tranche of worry from an age perspective came from millennials. And, if you just kind of read through the report, general consensus is that a lot of millennials that, are, entering or have entered the workforce, maybe not in a position yet to buy a home and are renting, concerned with the increase in the cost of rent and the increase in the continued price of just homes nationally, and worried that they may not be able to get there. So your thoughts on that report from CoreLogic and any of the other items mentioned in it?
It's interesting. I think we knew we were heading this direction where we were going to have certain people priced out of the market, as over the last 18 months where we've and longer prices continuing to increase. I know in the DC market, even this weekend, a realtor friend of mine over a holiday weekend had 3 bidding contracts, a bidding war for a purchase price of a $1.6 million house. We're just not, for the most part, seeing it level off. And then we're continuing to, in our affordable housing initiative, people, as we know, this administration has a strong focus on affordable housing, but even with that initiative, people are still not being able to buy their first home.
And then I want to get into that in much greater detail with you as we get into the show. The initiatives put out there by the Biden administration to add 100,000 affordable housing units. Get a little bit more into that. Also want to get your perspective as we go into the show, just as somebody running mortgage operations for decent sized depository operation, just all the tentacles that go into that. And we'll get into that as we go into the show. But same church, different pew. Another report kind of came out this morning from CoreLogic, basically saying they expect home prices to continue to appreciate as we get into 2022, albeit at a lesser level than they are now. But CoreLogic, one of the biggest aggregators of data and market trends in the residential lending industry. Some of the other things in the report were just, some comments from their chief economist and their CEO, just really talking about some trends that are troubling to them as it relates to home values and home price appreciation and the lack of solutions that exist there in the marketplace, going on to state that, housing in America has been underbuilt for 10 years and, really no signs of any kind of fix to the inventory side of our issue, at least easy ones. So I don't know if you had a chance to see the CoreLogic report, but your thoughts?
The builders are going to play a huge part of that. And currently, it doesn't seem, in our area in particular, that we're seeing a lot of initiative or forward momentum of the affordable housing coming.
And
with
that was
real-
mentioned specifically in the report, just reading through it here. There was a specific mention of the lack of supply is unlikely to be resolved over the course of the next 5 to 10 years without more aggressive incentives for builders to add new units. I got some family in Northern Virginia. I mean, I remember, you go there and visit them, you see the signs like townhomes starting at $800,000. Like what's like a 2,500 square foot, just, normal sized, like starter family home would go for in the Northern Virginia, DC area now?
It's around 600,000. And that's a starter home. So that price point for many first-time home buyers really isn't a starting point for them.
And you guys at Capital Bank, you're not doing, I don't think, a lot of construction lending, but are you
We do
dabbling?
some construction lending. We have a commercial division within the bank that does, especially in the District of Columbia, a lot of lending there.
Yeah.
And they do partner with our DC office mortgage team on the affordable housing.
Yeah. Well, let's go right into the affordable housing and affordable housing units discussion, making big waves in the industry. A week or so ago, the Biden administration came out, outlined a plan to add 100,000 affordable housing units. It was, there wasn't a lot of concrete stuff there. There was nothing in there that would have required congressional approval. Boost the supply of quality affordable rental units by relaunching partnership between Treasury and HUD. Boost the supply of manufactured housing and multi-unit properties by expanding financing through Fannie, Freddie, and FHA. Could be something there on the margins. Make more single-family homes available by limiting in ways sales to large investors, and working with state and local governments to boost housing supply by leveraging existing federal funds. So I think MBA, their official reaction to it summed up certainly what I was thinking, and what a lot of others in the industry were thinking was like, hey, this is great. Like anything helps. We have a major inventory issue right now with regards to housing in America, but true, long-term solutions that are going to really impact the supply demand kind of mismatch right now, they're initiatives that are going to require congressional approval. If it's incentives for builders to build lower priced homes, or other initiatives that are going to move the needle a little bit more. You run operations for a nice size depository operation, in a very diverse part of America, obviously. How do you look at this issue just in general? As a leader, as somebody, in terms of communicating to your people and kind of charting out direction and guidance for your group as, we try to navigate likely change that's coming here.
So as a depository institution, Capital Bank has been involved in community lending. And many areas like DC require LMI units and new multifamily developments. It's been a goal for them for a long time. I think we're going to see continued focus on that. As far as the regulatory piece, as an FDIC insured bank, we have a very robust compliance department. So we're not going to see much change there, because even prior to the Biden administration, Capital Bank has always been partnered in the community. Our DC lending team also mentors realtors, other loan officers on first-time home buyers. We also partner with a lot of the down payment assistance agencies. We layer a lot of our DPA, so we counsel the borrowers on what it takes to buy affordable home. We work with many of these customers anywhere from 3 to 6 months. We are actually excited about the Biden's announcement. We think it's going to continue to strengthen homeownership, especially in the DC area for us. But we also know it's not an easy answer, because it's not like we're getting a program that says, okay, if you lend to these 100,000 borrowers, you're going to get a point towards closing. Like that's not happening. So we still need to jumpstart the initiative in order to get any traction.
And I think you summed up, we are obviously an organization of depositories and non-depository mortgage lenders. And it's so funny just, talking to our, IMB CEOs and heads of ops and those who work for our depository members. And, kind of like you said, you're like, hey, we've been doing this. This is something we've been doing for a long time. We've got deep partnerships in the community with community groups, a number of different down payment assistance grant programs that are available to borrowers in the communities we serve. And that's not to say the independent mortgage banks haven't been at all involved in that or are not excited about, starting to participate in those initiatives should they be required to from a regulatory standpoint. But it's just it is a different ball of wax. It's kind of embedded into your DNA as a depository lender.
It is, and we have a dedicated lending team for it, which continues to grow. So it's nothing we haven't been doing anyways, but it is going to be a challenge for other people that haven't. And with the affordable home ownership, as there's always regulations, always requirements, and there's a cost to that. And it's also just from an operations standpoint, I have a dedicated underwriting team that specifically underwrites a lot of the DPAs because those loans take a little more time to underwrite, to be compliant, not just for our regulation and for loans we sell on the secondary market, they're layered. We also have to meet the DPA requirements. So you're not getting as much production out of your team for those transactions as well.
They're tougher deals to do. Like you said, you got to underwrite to the investors' guidelines. You got to underwrite to the guidelines of the down payment assistance provider. Sometimes other entities that are involved in those deals, and they are more complex and are not closing as quickly and ultimately cost more money to manufacture.
It absolutely does. And I actually I'm a huge advocate for cross training. I have a team that specializes in the processing, the closing of underwriting of all of our DPA loans, because if you make an error, the loan is not saleable to any one of the, whether it's the DPA or the investor. So we've already been set up to handle that. It goes through a different department than our normal general flow.
Yeah, and you talk about just smart regulation as opposed to like throwing things out there that sound good in politicians speak, like we see politicians do a lot, but maybe don't really move the needle when it comes to actual change. One of the things I've been barking about for years on this show and other places is just like we hear from our members all the time, if it's the state bond programs or other down payment assistance programs that help the borrowers that need it the most. First-time home buyers and ones that are kind of on the margin from a credit perspective, not only are they tough to do and require a lot more institutional knowledge and bandwidth to move those loans through the pipeline, but in almost all cases, you're capped at what you get paid as a lender when you sell that loan to whoever it's going to. And I'm not saying lenders should be making 6 points on these deals. But what every lender says is the same thing. We make zero money on them. We do them because it's the right thing to do. But it would be a smart initiative if government would maybe take a look at how they compensate lenders on some of these programs. No?
And they would probably get increased participation.
Right. Like,
it is. And you're under a time, the loans take a long time to move through the system. And you only have a certain amount of time to deliver those loans as well. So it is a process, and not all lenders want to take that on because they can't, because there is a cost, like we said, to it. So depending on whether you're a bank or an independent, it also makes a difference with these transactions. But I agree, I read the initiative last week, and there isn't a clear direction. It's a lot of words, but not a clear path on what they're going to do to get there.
I reread it this morning in advance of this show, like all the different, the announcement from the Biden administration. It was like, it would have been 3 pages if I would have printed it. And I got to the end, I'm like, what can be implemented that would make a change like today? So
I sent the article when it was announced last week to our community lending manager and I said, please read, here you go. And she responded back, thanks for sending, but we're already doing this. I said,
Right.
and she's been her whole career. She's
Yeah.
does community lending and she's not seeing that it's really going to make a difference yet.
Well, good opportunity for me to give a little shameless plug for our Community First Working Group that I know you guys and a lot of other depository members have been involved in. One of 10 different working groups we have as part of TMC that's comprised of all the community lending individuals and professionals that are part of our network that sit here and talk about all these issues that we're talking about here today on an intimate level on just a monthly basis and are able to network with each other in their own little sphere. So this is the last week in Mortgage Today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week joined by Capital Bank's SVP of Mortgage Operations, Lisa Lang. And Lisa, I want to move the conversation into a different but connected conversation. Would be just Fannie and Freddie in general. Obviously they're going, it's like, turning around a big boat. I mean, honestly, it was steamrolling one direction and now it's going the exact opposite way. We've heard from our members that, there's still the non-owner occupancy caps, which I'm not saying are a bad thing, but they're still being policed very heavily. Not, you would expect them not to be. That hasn't been unwound, nor really do I expect it to be unwound, but a lot of our lenders have been capped to maybe 3% on non-owner, which is significant to me. That's a small
Significant to us. It was significant.
Did you guys get capped at 3%? And how are you handling it?
We did. We've looked at lots of different options. We initially had hoped that decision was going to be reversed, but it's not looking like we're heading that direction. We have a Eastern Shore branch that just by nature, much of their business is second home business. So we were impacted. We looked at maybe portfolioing some of those loans, but we did, we've sold some direct. We're constantly, Heidi, who's sitting my head of secondary, is constantly daily looking to see where we are on our cap. It's an ongoing issue out of all of the changes. That is probably the number one change that impacted us the most.
Yeah, I mean, the conventional wisdom to me at least would be, maybe reducing people to 3%. I could see that getting unwound, but maybe they stick to the 7% cap of non-owner just because, really not technically in the core charter of Fannie and Freddie. That said, a lot of lenders like yourself, we have members that like their business is largely like centered around non-owner occupied properties. Like, I live in Ohio. We have a lot of Ohioans that move down to Florida and other warmer places. So locally, I know a lot of lenders that, it's not all their business, but like, a third of their business is non-owner investment. So it hurts those people. But conventional wisdom, I can't see them completely unwinding the 7% cap. Very likely that all the other stuff in the PSPA, some of the other limitations that we were talking about probably never get implemented. But just in general, like, LP and DU, we're hearing also from members that those credit boxes have gotten tighter, and that they're getting deals not approved that maybe would have been certainly a year ago, maybe even a couple months ago. At the same time, they're reading headlines about Fannie and Freddie expanding their credit box, like in, the affordable housing proposals. And so it's kind of a weird climate right now with the GSEs, no?
It absolutely is. And we are noticing that many of our loans that, I don't want to say many, but a percentage of our loans that we're getting accept, we're now having to restructure, try and fit it in a box that it's going to get an accept. We do as an institution typically try and steer clear of a manual underwrite. So we really need those loans and require those loans to have an AUS accept. We're also noticing when we're selling to our aggregators, we're starting to get more questions on appraisals for inflated values.
We've heard that as well. What about appraisal turn times has been another topic that's come up with leaders, just that being a nightmare right now. And it was I think Allison Johnson from Success Mortgage Partners was co-host last week or 2 weeks ago, and said they were just basically like negotiating with appraisers, like when they needed somebody to get out there, like at 800, 1500, 1600.
We're seeing the same thing, and it's been an ongoing topic. We lend nationwide, and I was on that call. We got quoted the same price for a property in Texas. The turn times are still not anywhere near acceptable, but you just have to deal with it. It's like they're extorting the lenders. So, and really it comes to the lenders because when we're quoting up front, we're not quoting $1,800 and $1,600 for an appraisal. So we typically, when that happens, we cover it because it is not the consumer's fault that the appraiser, A, can't appraise it in time, and B, the price has changed. So that's another ongoing issue for us. We are looking at options on how we can reduce and eliminate that problem. You would think, and I actually have spoken to many of our AMCs, and they're also at the mercy of the appraisers. You know, they say, we will get appraisers that just decline until the price goes up, up, up.
Yeah, it's
the irony is years ago, we thought we'd have no, just, you know, oh, we're gonna all have drive-bys. We're not gonna have the need for appraisers. Just like when AUS came out years ago, we're not gonna need underwriters. And those are the two professions over the last 18 months that we've needed more than ever.
It's so ironic, and there still is no e-close somehow in the mortgage industry. Like,
I know. It's interesting. Everybody wanted e-close, so I got them e-close. Now nobody wants e-close.
Well, now you see what there's so much like investment in mortgage fintech and other things, because these things have to come. I mean, it really is insane when you think about it. I mean, I remember talking to you and Heidi, your head of cap markets last year, like in the throes of the pandemic, like just the challenge in, you know, first going virtual and just, you know, the amazing amount of business started coming in and needing to hire people. And, you know, you work for a bank. I worked for banks for a lot of years. So you can't just go out and like, I need to hire 20 people. Like, it's not quite that simple. Our process is still so human in areas where it really doesn't have to be. Like you said it exactly. Like we years ago, you know, we were hosting sessions here at TMC about, you know, the potential, like not decline of the appraiser, but, you know, the
reduction in
that part going in a different direction. And yet here we are with still a very human manual mortgage manufacturing process in place.
Absolutely. So, and additionally, same thing with underwriting, right? Even with the AUS, and so you can approve eligible, it's never really approve eligible because we're getting that second audit when we go to sell the loan, and then when they go to sell it in a pool, it's coming back. So the lender is really always on the hook for the loan.
Yeah.
And we're seeing a lot in the deals as the market is starting to constrict a little bit. The deals are getting tougher.
Yep. You're right. And we've heard that as well from members of ours. And it's going to be very interesting. You know, I think there's things from a like guidelines and policies standpoint that Fannie and Freddie are going to be able to do over time to help loosen the credit box a little bit. I think it's clearly going to go in that direction, but like the things that you don't see in print, just when you get an accept or an approve and you don't, like those deals on the margins that, you know, we heard last year were getting approved and now they're not getting approved. The tweaks that we're going to see there, and we would love to be able to lean on you as well as other operational leaders in the network we've leaned on, just to continue to take the pulse of our members as that continues to evolve, you know, throughout the rest of this year and into next. So
they're going to need, Fannie and Freddie are absolutely going to need to step in if the Biden administration's initiative is going to move forward. We can't say we're going to do all of these, but then we have nothing to support that. And you're going to handcuff the lenders where you want them to make these loans, but yet they're not going to be able to because we can't buy them, sell them.
Yeah, no, absolutely. And to be fair, Fannie and Freddie have been so much more engaged with us, just TMC. We have longtime partnerships with both organizations. During the Trump administration, especially at the end when Calabria was really taking things, down the path of, privatizing the GSEs. They wanted to work with us on things, the key leaders that we worked with, but you could just tell they were hamstrung a little bit. Now it seems like there is a real sense of hope's the wrong word, but just how they engage with an organization like us of Lenders Across America, much more optimistic. And so it's going to be, you're right. Is it going to take Fannie and Freddie, in the outlined plans from the Biden administration on the affordable housing units and the growth that they want to achieve there? There's some loose stuff there that involve Fannie and Freddie, but there's going to need to be, to your point, some real tangible changes with the GSEs to help them achieve the goals they want to.
Absolutely. And I believe everybody within our industry really wants to support homeownership, no matter what type of transaction it is. But first-time home buyers, affordable housing is a huge initiative that we all need to be partnering on.
Yeah. And I think just being honest, like all the stuff Biden's going through now with Afghanistan and all that, like these are initiatives that will help our industry, will help housing in America, but they will also, I think, to a large amount of Americans be viewed as, it would be good press, good PR, probably something they could use right now. So I think that will help even more, I think get forward movement on some of the housing related issues that have been talked about a lot, but we haven't seen a lot of action on yet.
In your area, are you still seeing multiple contracts, or is it leveling out a little bit?
It's leveling out a little, like I would say, like like Ohio. Like I bought a real nice house for like 480. So it's kind of like the middle. So like the 150 to like 300 range, it's ridiculously competitive. Like, I mean, still just as competitive really as it was in the spring. And then on the higher end as well, probably less overall bids because you just kind of shrink the pool of people that can bid on them. But, in the more middle area, I think it's more, it's subsided a little bit. So, which, I think is probably consistent with what I've heard from some of other members in Midwestern towns. So.
We are, it's seasonal, so we are seeing more sales on our Eastern Shore side where the vacation homes are sitting just a little longer. I mean, before it was multiple contracts. Now we're starting to see take a little longer, but there's still a shortage of housing. So we're still from low to moderate to high, seeing multiple offers.
Yeah.
Across the board.
This is the last week in mortgage today. I'm Rich Swerbinsky with the Mortgage Collaborative. This week joined by Capital Bank's SVP of Mortgage Operations, Lisa Lang, and just a couple minutes left with Lisa. Lisa, it feels like refis are kind of bleeding out, that we're losing the momentum there, right? We've had, Delta variant and other related dips to mortgage rates that, dropped that 30-year fixed rate back in that 2.7, 2.8 range. And we just haven't seen the pops in refis that way before. It feels like that's kind of losing its steam now.
Totally agree. We've seen it coming and trending this way over the last 30 days, but really the last couple weeks. Our purchase market is still very robust, very strong, but refis are ebb and flow, depending where rates go that week. You might get a pop of a few loans or more locked in on refis, and then that's it. And then it's just, there's no consistency, and they're definitely starting to level out.
Any other trends just in general you've seen, with regard to the pipeline, general business climate these last 30 to 60 days that stand out to you?
So it's interesting. I was sharing with Heidi, as we all know, it's been very, very hard over the last 18 months to hire staff. We're really not even hiring anymore. Recruiters and things like that we used in the past are sending resume after resume after resume for people. So I think some operation staff are getting nervous. I think they're seeing the slowdown in the pipeline. And I also think some companies have started to, reduce staff as well.
Yeah, we've kind of heard and seen the same as well. And just we've heard some from the lenders that, ops employees, it's been a tough 18 months, and they've made a lot of more money. I mean, either just, leaving a job and going to one that pays better, or through OT or production bonuses of some sort. So we've heard from some lenders that, like, the cost to originate and the loan manufacturing process being so human, those have even been more exaggerated through the pandemic, and the desire to bring in some younger, maybe even people you kind of got to train on your own.
Which we have done, and that's been, for the most part, really successful for us, because they come in with great attitudes, the willingness to learn. Anything you ask them to do, they absorb and soak in that information. So that's actually was really great to see. Versus you hire somebody who's like, oh, here we go again, same stuff, different day.
Lisa, as always, really enjoy talking about the industry with you. I really appreciate you coming on as my co-host again this week.
Thanks for having me.
And you may be returning the new show, another shameless plug here, but starting a new show called Monday Mortgage Quarterback, every Monday during NFL season at 11 a.m. Eastern. We're going to kind of take the 3 top NFL games of the week. I'm going to bring on lender member representatives from the 6 cities involved in those 3 games. We're going to have a little fun going over the results of the games, but also to get some insight into the local housing market. So before we went live, I officially got Lisa to be one of my Washington football team, aka Redskin representatives, and her VP Capital Markets, Heidi, that's going to do the same for the Baltimore Ravens. So
You better brush up on her football stats.
Right.
She's sitting on the other side of me. So,
Well,
All
good
right,
stuff.
thank
And
you.
no problem. And to our attendees, thank you as always for taking half an hour of your Tuesday afternoon out with us. We are here, same time, same place, every week, every Tuesday at 2 p.m. Eastern with the Last Week in Mortgage today. Until then, have a great rest of the week, everyone. Take care.
Bye.
Bye, Lisa.